Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Rolls-Royce's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 34 billion pound market cap. They're trading at 405 pence or £4, and they have 84 million shares outstanding. They do trade OTC in the US, ticker RYCEY, R-Y-C-E-Y, and that trades for $4.95. It's a little confusing. The London Stock Exchange trades in pence, not pounds, while the US Stock Exchange trades in dollars, not cents. If you live in the UK, let me know if you have more information. I just Googled it. This is what I found. Since 1971, shares are traded in pence instead of pounds, because at that time there were very few companies with share prices over £1, so they quoted everything in pence. In 1971, Britain finally moved to a base 10 system, because I'm sure it's really confusing under the old system. In the old system, there were 12 pence in a shilling and 20 shillings or 240 pence in a pound, which makes doing the math for a clerk at a store a bit complex. Rolls-Royce Holdings is an aerospace and defense company. It designs, manufactures, and distributes power systems for aviation and other industries. They are the world's second largest maker of aircraft engines, after GE Aerospace. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. A really big negative in 2020. It got a little better, negative 800 million pounds in 2021. Then a positive in 2022. Then it grows 90% to 1.8 billion pounds in 2023. So they rebounded nicely. And their margins are up to 11%. They converted 11% of their revenue into free cash flow. Free cash flow per share is 21 pence. Net income is the profit or loss on the income statement. It's revenue minus expenses. That went from a really big negative in 2020 to a big positive in 2023. And pretty good margins. They converted 15% of their revenue into net income, and their net income per share is 29 pence. Revenue is a sales for the company, and that was flat from 2020 to 2021, then grew 21% into 2022, grew 22% into 2023, 16.5 billion pounds. And their revenue per share is 200 pence, which is about half their share price. We estimated 4 years of future free cash flows. We also estimated the terminal value of all cash flows past year 4, that's 46 billion. We discounted those numbers back to today using the weighted average cost of capital. We got a value of the company of 40 billion pounds. We divide that by 84 million shares. And we get a calculated stock price of 473 pence. They're trading at 405 pence, so they're trading at a 15% discount. It's a buy according to the model. This company has such a long and rich history, so I definitely don't think they're going bankrupt. But I can't imagine the stock going up that much in the future. I think maybe in the next 5 or 6 years it can double, but I can't see that much more upside. There are 66 companies in the same industry as Rolls-Royce, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. I converted all these numbers to US dollars, since all the other tickers trade in the US. That's why this market cap is higher than the one in my Excel file. The one in my Excel file is in pounds. This is US dollars. They spent 900 million in CapEx. RTX spends the most at 2.4 billion. We can't look at their debt to equity ratio. They have negative equity, which means their liabilities are higher than their assets. They do not pay a dividend. They used to pay one. They'll probably pay one in the near future. They generate a good amount of free cash flow, 2.2 billion. Lockheed generates the most, over 6 billion. They rank 7th in market cap. Here's Boeing at 3rd. They used to be the biggest. They have negative equity, so we can't look at their price to book. They have the best PE. They're trading at 14 times earnings, so it looks really appealing. They're trading at 19 times free cash flow. That's also really good. And 2 times revenue, which is a little worse than the median. They generate lots of revenue, 21 billion when converted to US dollars. If you put $10,000 into this company 10 years ago, you would have been in the red like 98% of the time. At one point, your 10,000 would have been down to 1,000. The stock has come back, but you're still down about 66%. Let's go through their 2023 financials. This first page highlights some of their results. Operating profit, £1.6 billion, 10% margins. They've been working really hard to become more efficient, cutting expenses, focusing on the more profitable segments. Record free cash flow, $1.3 billion. That's driven by operating profit and LTSA, long-term service agreement. Return on capital more than doubled to 11%. Operating cash flow, $2.5 billion, $1 billion higher than last year. Net debt, $2 billion, that's debt minus cash, down from $3.3 billion. Their guidance for operating profit for 2024 is 1.7 to £2 billion. Free cash flow, 1.7 to 1.9 billion. Their revenue for 2023, 16.5 billion pounds, up from 13.5 billion. Operating profit, 2 billion, more than doubled last year. Big margin improvement from 6.2% to 11.8%. Their EBT, earnings before taxes, 2.5 billion, compared to negative 1.5 billion. That gives them an EPS of 29 pence. Operating cash flow, 2.5 billion, up 1 billion. And net debt down to negative 2 billion. And the way these companies make money is when other companies fly. The more other companies fly, the more these companies can service those engines. Because when they sell engines, they don't make that much money. They make a lot of money when they service the engines. And not many people were flying in 2020. Large engine flying hours recovered to 88% of 2019 levels, which is up 65% from 2022. So we're almost back to pre-COVID levels. And large engine orders were the highest in more than 15 years, with major orders from Air India and Turkish Airlines. Their underlying operating margin more than doubled to 10.3%. The largest improvement was in civil aerospace, which had an operating margin of 11.6% compared to 2.5% last year. They're one of the largest defense contractors in the world, although they spell it with a C, not an S. Defense contractors is when you sell to the government. And they sell a lot to the UK government. And I think they do have some sales to the US government. Record cash generation. That's how you run a business, on cash. Free cash flow up 150% to 1.3 billion. And they're not paying a dividend. They didn't pay one in 2023. But I think they will this year. They just want to get their balance sheet a little stronger. When they do that, they are committed to reinstating and growing shareholder distributions. Here's their 2024 guidance. Operating profit, 1.7 to 2 billion. Free cash flow, 1.7 to 1.9 billion. Here's a breakdown of their 15.4 billion of revenue. 7.3 billion in civil aerospace, defense 4 billion, power systems 4 billion. And that's up in each category, up the most in civil aerospace, 29%. And their profit is up 500% in civil aerospace. Here's a breakdown of their free cash flow generated in 2022. 1.3 billion in 2023, more than doubled 2022's number. Civil aerospace went from 226 million pounds to 626 million. Defense up a little bit to $500 million. Power systems nearly tripled from 150 to 460. Large engine deliveries in 2023, 262. Business and regional, 196. Total deliveries, 458. LTSA shop visits, this is where they make all their margin. That's up 18%. Major shop visits is up 27%. Revenue, 16.5 billion. Gross profit, 3.6 billion. Operating profit, 1.9 billion. And EPS, 29 pence. Here's their income statement, 2023 versus 2022. Revenue went from 13.5 billion to 16.5 billion pounds. All the expenses directly tied to generating the revenue are 13 billion pounds. So gross profit, 3.6 billion, up from 2.8 billion. Admin costs, 1.1 billion. R&D, 700 million. So operating profit, 2 billion, more than doubled last year. They received 1.2 billion of interest on their investments. They paid 680 million of interest on their debt. They paid a lot more last year, 2.8 billion. They've been shedding a lot of debt. So their net profit, 2.4 billion. Really impressive improvement. They have total assets of 32 billion, up from 29 billion. They show assets from least liquid to most liquid. That's why cash is on the bottom, 3.8 billion of cash. Trade receivables, how much money other companies owe them when they sell on credit, 8 billion. Inventory, almost 5 billion. and they have $4 billion of intangible assets, $3.7 billion of PP&E, $3 billion of deferred tax asset. This will help improve their taxes in the future. Total liabilities $35 billion, so their liabilities are higher than their assets. That's why they have negative equity, negative $3.6 billion of equity. Their biggest liability is contract liabilities, $8.4 billion. A contract liability is recognized when a customer prepays for something, but the contract has not been completed. When a contract is completed, then they remove the liability and record the revenue on the income statement, but it's carried on a liability until this company fulfills the contract. Maybe the contract is for 3 engines and they paid for 1 engine. If we look at the equity section, they have accumulated losses of $7 billion. This is the sum of all their prior net incomes minus the sum of the dividends they paid out. So historically, they lose money. So let's take a look at their statement of cash flows. The first section is operating cash flow. They generated $2.5 billion, up from $1.5 billion. Really big improvement. The main reason was a $2.7 billion of contract assets and liabilities. Last year was $1.8 billion. So this means they received a lot of cash in 2023, but they still need to fulfill that obligation. They purchased $400 million of PP&E, and they added $284 million of intangible assets. This is through acquisitions. In the financing section, you can see how much debt they borrowed or paid, all the dividends they paid, which weren't any, the interest they paid on the debt, and if they diluted any shareholders. So not much going on in 2023, but a lot in 2022 because they paid back a lot of debt, $2 billion. Of the $15 billion of revenue, $7 billion was from the sale of equipment, $8 billion was from servicing the equipment, and it's much higher margins in servicing. In civil aerospace, $7.3 billion of revenue, defense with a C, $4.1 billion, and power systems, $4 billion. And they profit in each category, $1.6 billion of operating profit. They did profit in each category in 2022, just not as much. Let's look at a stock on Simply Wall Street. It's trading at £4. That's interesting. Simply Wall Street lists a stock in pounds, not pence. 34 billion market cap, down 4% in the past week, up 170% in the past year. Let's see what they say about the company. Rolls-Royce develops and delivers complex power and propulsion solutions for air, sea, and land in the UK and around the world. They operate through 4 segments: civil aerospace, defense, power systems, and new markets. The civil aerospace segment develops, manufactures, markets, and sells aero engines for large commercial aircraft, regional jet, and business aviation markets, and also provides aftermarket services. The defense segment is involved in the development, manufacture, marketing, and sale of military aero engines, naval engines, and submarine nuclear power plants. The power systems segment engages in the development, manufacture, marketing, and sale of integrated solutions for on-site power and propulsion under the MTU brand name. The new market segment develops, manufactures, and sells small modular reactor and new electrical power solutions. They were founded in 1884, headquartered in London, UK. This shows a stock price back in 1992 at £1.37. It was down to 71 pence in 2003. It peaked in 2014 at £12.5, and then it came down in 2015, then back up in 2018. Then it fell below £1 at the end of 2020. And you can see it traded sideways for a few years. I wanted to pick it up in 2022, but I decided not to. It creeped up a little bit at the end of 2022, beginning of 2023, but it only grew about 10-15% over the next 6 months. It really took off in mid-2023. It was £1.5, then it finally hit £2 in October 2023, and then it more than doubled since then over the next 6 months. So I don't think there's that much more upside, a little bit maybe, but I could see this trading sideways or even lower over the next few years. Simply Wall Street does not agree with me. They're close to £9. They say it's 54% undervalued. 17 analysts priced this stock at £4.4. Here's their revenue target the next few years: £16.8 billion in 2024, $18 billion in 2025, $19.5 billion in 2026. Their free cash flow target for 2024 is $1.9 billion, 2025 $2.2 billion, 2026 $2.6 billion. Their revenue back in 2013 was $14 billion. It peaked at $16.5 billion in 2019, Came down a lot in 2021 to 11 billion, but it's starting to creep back up there. 16.5 billion currently. Pretty close to its all-time high. This red line is their debt, and the blue line is their equity. So since 2018, they've had negative equity. They do have a lot of cash on their balance sheet, almost enough cash to pay down all their debt. Their dividend in 2015 was over 3%. When you look at this chart, it seems like they pay a dividend, but they don't pay a dividend. Let's add their dividend payments. So you can see they paid a dividend through 2019, and the last dividend they paid was October 2019. But they forecast the dividend to be 1.6% by 2026. The CEO's salary is 1.25 million pounds. Total compensation, 13.6 million. And his tenure as CEO is 1.3 years. In the past year, there's been a lot of insider buying, no selling. 77% of the companies held by institutions, 21% by the general public, 1% by employee stock purchase plan, and 1% by public companies. Their biggest shareholder is BlackRock at 7%, then Causeway 4.5%, Vanguard, Fidelity, BNP Paribas, HBO, the Rolls-Royce employee stock purchase plan, Exor, this is a Dutch company. If it says NV, that means they're based in the Netherlands. And their employee count has gone down from 55,000 to 41,000. The ticker trades on the OTC Pink Sheets, Deutsche Börse, London Stock Exchange, the BATS Europe, and the Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.